about it. The market closes strong. The market opens. At one point, it was a green candle because it was showing a high. So people would have bought that high. So from at here, if you go across our screen, would say, okay, we got in at, if you bought that breakout at 129.67, and all of a sudden the market goes all the way down to 129.44. That's taking heat on the trade. You're probably at that point not feeling too good about that trade. So if you wait for the pullback of the benchmark, the breakout, look for the midpoint to buy, use your stop below the open. Look how much risk you've effectively taken out of the market. You're risking from here to there. You might not be able to buy that low, but you certainly didn't buy that high. And therefore, that would normally be your risk. So what do you want? Do you want your risk to be in this zone here, down to your open? Or again, do you want it to be way up here? So when you see and identify those benchmark breakouts, look to do what? A, wait for the pullback, and then look to go long. At the midpoint, risk a stop close only below the open. Here's a great example. The market has this beautiful breakout of a sideways consolidation. The market breaks out. People look to go long. And all of a sudden, they're not feeling too good. The market breaks all the way back down. And in this example, we actually went below the open, as this green line indicates. But notice the market never closes below the open. In fact, let's look at this equal and opposite, or we call these chopstick patterns. See how the real body is red? The very next session is almost equal, but yet opposite of the real body. See that? We have an open here, close down. The market opens and closes back up. If you took the average of that close and that close, where would you be? Right here at this blue line, wouldn't you? Isn't that amazing how that coincides and it's just a coincident factor? Equal and opposite. Bottom line, the open needed to be defended on a closing basis, and it was. You took literally no pressure on that. In fact, the market came back, tried to check that opening range, and took off in blast off mode. Again, another breakout benchmark candle. What do we see? The midpoint tries to act as defense. It doesn't even quite get there, and the market continues its ascent. Once again, different market, different day. This is a 5-minute period. Breakout market, breakout candle, benchmark. Why get long on the breakout? Wait for the midpoint to recheck. We do. Therefore, you reduced your risk from buying on the high or the breakout to the open, a stop close only. And again, wait for this market to give you confirmation of the upside. Here we have a couple other bonus features. We have a doji range. Notice the market doesn't even close below the doji's low. We have high close doji occurring here. That's helping a cause for a bullish indication. And again, this market takes off. So it's a beautiful trade if you just give it time to stay with the trade on a 5-minute basis. If getting in close to the midpoint of this gets you in around 136.15, and now you have a beautiful 40 pip gain on a market, rather than looking at buying the high and selling the low and taking heat on a trade. They also work in downtrends. Midpoint should act as resistance. If the market's truly bearish and you see a long, dark candle like this from a top pattern, the midpoint should act as resistance, and it does, as this example shows. And sometimes the market doesn't quite get to that midpoint. So instead of looking to sell in the hole, remember, if the market has resistance, instead of selling down here at these lows and taking more heat on the trade, wait for the pullback near the midpoint. Your risk is a stop close back above the open on the breakdown benchmark or blast down candle. Now, incidentally, I just talked about chopstick patterns, equal and opposites. They're called chopsticks as well. We also consider them in Chinese. It's called the yin and the yang. The yin is a black or negative close candle, and that would be what we give a negative assigned value to. Remember, if the market closes below the open, it's a negative assigned value. The black or red candle, as we would see on color charts, if it was color charts, it's red, is considered the yin. The yang is white or positive, and we give that a positive close value as the market closes above the open. Now, equal and opposites really occur with these false breakouts or key reversals, and we just saw one within the benchmark, by the way, that equal and opposite, where the real bodies almost have equal distance but opposite reaction. And a lot of times they're in